Hello, it's Keith Fitz-Gerald, and welcome to today's 5 with Fitz. I've just come back from a spectacular run. This is one of my favorite times of the year because the air is crisp, cool, clear. The coyotes are out. The owls are just hooting away. I wish you could see, hear, and smell the air up here in the Pacific Northwest. But enough of that. Let's talk money and markets. It is another day and another set of tariff announcements. Now, I hope you're on board. Much to the consternation of many folks who thought they were being smart by going to the sidelines in early April, something I told you point blank not to do, the train is now leaving the proverbial station. The S&P 500 has tacked on 11.8% since putting in lows on April 7th, and individual companies, including many that we talk about regularly right here, have done considerably better, which is, of course, exactly why we focus on them. Now, the smartest folks in the room are still out there peddling their unique brand of schlock, doom and gloom, which has many wondering if the rally can continue. Think about it. I believe the answer is yes. To paraphrase one of my favorite rock and roll bands, Bachman Turner Overdrive or BTO, you ain't seen nothing yet. Here's my playbook. Number one, Palantir is now one of top 10 most valuable U.S. tech companies. Haters wanted failure. But Wall Street just served up $117.85 a share as I record this. And right on cue, here comes the valuation crowd. Ironic, isn't it? They've been saying the same thing since Palantir DPO'd. It's expensive, valuations are obscene, it's too high, it's unrealistic, astronomical. You get the idea. But compared to what? Trailing earnings based on outdated accounting methods created to measure physical goods and services, not the digital world we live in today? It makes no sense. The markets are forward-looking. Nvidia traded at 62x earnings in 2022, if my memory serves. But in 2025, actuals were 5x what analysts projected back then, making that too expensive thing and multiple look like a bargain. Wait till Palantir gets to $200 a share. Imagine what they're going to say then. But I digress. My only fear personally is that I don't own enough shares, so I got to go do something about that. Keith's investing tip for this situation. Valuations are increasingly irrelevant for high tech. Get it through your thick skull, folks. High return to scale companies, for all the reasons we have talked about, are the place to be. And we've talked about them a lot in One Bar Ahead. The sooner you understand what this means for your money, the sooner your portfolio can thank you. Now, number two today. Will just 80% bring China to the table? U.S. President Donald Trump has floated the idea this morning that an 80% tariff on Chinese goods seems right. Now, that's ahead of scheduled U.S.-China trade talks in Switzerland, where Treasury Secretary Scott Bessent will meet with Chinese officials, including Vice Premier He Lifeng. Now, if you're keeping score, here's what matters. That's down from the 145% level that's currently hitting many Chinese goods, but it is still 8x higher than the 10% baseline the UK just locked in. Now, why would the president do that? It's because President Trump wants to give China a way forward, or something called guanxi, which loosely means face, if you're not familiar with, or you are familiar with that concept. Now, will it work? That remains to be seen. China's optics are very different, and President Xi will no doubt present this to his citizens as China being so strong that the U.S. is caving in before the talks even start. Now, I could make the argument under the circumstances that buying a broadly based Chinese ETF like FXI might make for an interesting and potentially very profitable 12 months ahead. My preference, though, is to stay with a Chinese company that's already a global player and which has returned 77.82% over the past 12 months versus 9.64% from the S&P 500. Now, I think it's just getting started, too, and I expect the outperformance to continue, but that's neither here nor there. What I want you to focus on is this. Investing because of China, not necessarily in China itself, may be the better play here. Now, Keith's investing tip. The smart money never waits for the headlines to invest. It positions ahead of them, which is something I call Keith's rule of the back page. And what I mean by that is that people waiting for front page news tend to be a day late and a dollar short, often quite literally. Number three today. I am amazed that Peloton still exists. Peloton just posted its third straight quarterly revenue decline, and Wall Street's not buying the spin, literally or figuratively, pun absolutely intended. Now, I've told you to avoid it for a long time. since it IPO'd, in fact. Revenue came in at 624 million, a touch above estimates, but still down 13% year over year. Now that makes 3 in a row despite a shiny new CEO and another reheated turnaround pitch. Frankly, again, I'm amazed the company still exists. Like an old Soloflex, you remember those? It's on the cusp of being a very expensive laundry hanger for many folks. That or a garage sale special. I mean, man. Anyway, Keith's investing tip here. This is exactly why I suggest you stick with world-class businesses making must-have products and services rather than companies built on pandemic hype and hope. You can swap out all the CEOs you want in a situation like this and strike all the deals you want with hotel chains, fitness outlets, subscription agreements. It doesn't matter. If nobody wants the product, the ticker is still going to go downhill because the company is going to be less valuable. Number 4 today, don't bet against Uncle Jensen. Now, back in April, the market was worried about Nvidia having a $5.5 billion charge tied to unsellable H20 processors and blocked export commitments to China. Shares dropped faster than a rookie in a zero DTE options pit, and most people panicked. Now, I told you not to. In fact, I told you get on board and buy. Why would I do that? Because as I said back then, 5.5 billion sounds like a huge number, but it is just a minuscule 4.2% of Nvidia's projected fiscal 2025 revenue. If that rattles you, you're not an investor, you're a speculator. Fast forward to today, Nvidia is not rolling over, but the company is instead recalibrating. It's just notified Chinese clients that it's prepping a downgraded H20 chip for release in July, designed specifically to navigate Washington's AI export restrictions. The new chip will have reduced memory and power, but it still keeps Nvidia in the fight right where and when it matters most. Now, my POV on this is simple. This is classic Jensen. It's tactical, resilient, and laser focused on the long game. Betting against him today would be like betting against Apple founder, the late Steve Jobs, in 2007. And, here's the deal. Nvidia shares have returned 450% since I brought it to the OBA family's attention compared to 41.19, which is great, but still far less from the SPY, a popular S&P 500 ETF. That's an 11x performance advantage from picking a world-class player as opposed to sweeping a broad net. Now, history suggests, and the reason I bring this up is that history suggests there are 10 to 15 Nvidias out there right now as I type, which is why you ought to be laser focused on finding them just like I am. And if you want to know how to find them and you don't have any idea how to do that, excellent. If you'd like some help, you know where I am. I'll be right here. Number 5, cargo crooks and the next billion-dollar opportunity, speaking of which. Organized criminal networks are targeting U.S. freight routes with increasing sophistication, and cargo theft is exploding as a result. Now, this is an amateur hour. We're talking about strategic heists, deep fake brokers, hacked platforms, identity theft operations that now span over 30 countries. Losses are approaching $1 billion a year, with criminals using the same technology that was supposed to make the supply chain smarter. Now, is this an investable opportunity? I think it is, and it's a big one because vulnerabilities this big create profit pipelines for companies that will offer end-to-end security, supply chain security, cybersecurity and AI-powered fraud detection, insurance and risk mitigation, hard asset tracking and geofencing technologies, resilient third-party logistics, 3PL, in-house security stacks. I mean, everything is an investing opportunity if you think outside the box. So, anywho, long story short, I'm researching a few candidates in this area because it's a new one for me, but I haven't settled on a specific choice just yet. How about you? Write in and let me know. And and lest I forget, if you're an OBAer, by the way, keep your eyes on your inbox because this morning you'll be getting an update. This week's AMAs, a stock that's flying under the radar for many but deserves a lot more attention, kind of like the freight situation. It's a bargain and a half to my way of thinking, and those are words I don't use lightly. Today's bottom line, people have a lot of doubts about themselves right now, about the markets and about life. That is absolutely normal. However, it's also why I insist that you make it a great day. Have everybody, have a great day. That's for everybody else. Make it a great day and don't let anybody or anything stop you, not in life and certainly not in the markets. So, as always, let's make it a great day. Let's finish the week strong. You got this, and I will see you on Monday. Thanks for watching. Have a great weekend, and more importantly, make it an outstanding weekend. Happy Mother's Day to all you moms out there.